This video is targeted for those futures traders who are considering dipping their toes into the Forex market and want to know what they should know before doing so. The following will be an outline of the basic differences between trading the two markets and the most important things that you should know. So let's get started right after this. Forex is the direct purchase of an asset. Okay, where futures, you're buying contracts that are based on the value of an underlying asset. So when you're selling the US CAD, you're actually exchanging your US dollars for Canadian dollars. If you were to sell coffee, you're exchanging your money for a contract that is based off the value of coffee. So you're not trading, a hard asset with futures, but with the Forex, you're trading the hard asset. And in a lot of cases, the brokers will actually let you take that money out, providing that you have a bank account in that currency. The Forex markets stay open from when they open on Sunday evening all the way till late Friday afternoon. Okay, so they don't close for that 30 to 60 minute window like the futures markets do. They will remain open all the time, and they don't have contracts that expire. So you don't have to worry about any sort of a forced cash settlement. Now with Forex trading, a pip is a term used to define the smallest amount of change in price. So with Forex trading, the Euro USD could be a quote of 1.3498 US dollars. Meaning if you sold 1 euro, you would get 1.349 US dollars. If the Euro USD would go up 1 pip, you would be going from 1.3498 to 1.3499. Now, if you use a contract size of 10,000 or basically one mini lot, the difference of that price would be roughly 1 US dollar. If you wanted to trade a standard lot or the size of 100,000, then that would be the difference of $10. Now with the Forex, you're not going to be trading on one central exchange. All the brokers get their prices from the banks, and not one bank is responsible for all the country's currencies. Okay, so they all might have slightly different prices. Now, back when Forex was being traded in the early 2000s, electronic trading was the latest and hottest thing. Brokers took advantage of different pricing, which left some traders feeling like their broker was moving price to stop them out of positions. This was all this is the Wild West. Okay, those days are over. As long as you're trading with a regular broker. If you go to, let's just say, an obscure country, you still might see some of this stuff happening. So slowly the stigma of Forex trading being the wild, wild west has now been going away, and it's been seen as an equally good market to trade. The great news here is because Forex doesn't run on a central exchange, you never have to pay for Forex data. Now with the Forex, there are many more instruments available to be traded because there's many more countries than there are commodities. For technical traders, the more charts, the more potential opportunities. So this is why people who might trade patterns could eventually look at different markets and different types of markets like the Forex so that they can see more patterns and be much more selective. That doesn't mean that patterns do not work well on futures. They do, but there are less commodities, so there's less patterns to be traded. Quite often, this is a reason why people look at as many markets as they can, because they're applying the exact same thing to every chart that they see. Now, trading the FX markets are usually a lot cheaper. You don't have to pay for data, and the cost of issuing a trade should be far less than the cost per trade than if you were trading futures and you don't have that monthly data fee. Now, each market, if you trade, whether it's futures or Forex, will both have advantages and disadvantages. And you might see, not having an expiration date is a positive thing, or you might see that having more charts to look at is a positive thing, or being able to adjust your contract size so that your risk isn't as big as a positive thing. Either way, you have to look into your own situation, do your own cost analysis, and see, is this something I want to get into? Yes or no. Now, regardless if you trade futures or Forex, you probably are going to want these two free tools. The first one puts news events vertically on your line so that you know when they're coming out well ahead of time. And the other one puts a Priceline indicator on your chart so that you can always see where current price is in relationship to the past data. So grab those two. They're both totally free. Links are in the description. Until next time, trade safe, and we'll speak to you soon.